Open your banking app. Right now. I'll wait. Look at the number next to available balance. Here's the part nobody tells you. That money is not in a vault. There's no little box in Ohio with your name taped to the front. Roughly 90 cents of every dollar you're looking at is somewhere else right now. Inside a car loan, inside a strip mall in Tulsa, inside the roof on somebody's house 3 states away. Your balance isn't money. It's a promise that money will be there if you ask for it. And making that promise at scale to thousands of people who all quietly agree not to ask at the same time, that's the strangest business model legally operating in the United States. So today, we're building a bank, not a fintech app, not a neobank sitting on somebody else's charter, an actual FDIC-insured bank with your name on the sign. I'll show you the math, why the margin on each dollar is insultingly thin, and why bank owners get rich anyway, why 4,278 of these exist today, and why that number shrinks every quarter, and why a bank can be boringly profitable Tuesday and dead by Friday. I spent 6 years inside this industry, credit analysis, deposit pricing, then 2 years on a treasury desk at a bank you've never heard of. I've sat in the room where they decide what your savings account earns. So a lot of this I watched happen. Let's go. Hold on to this for the next 17 minutes. A bank does not sell money. A bank sells the gap. It rents money from one group at one price, rents it out to another group at a higher price, and keeps the difference. That's the whole thing. Everything else branches, apps, the guy in the vest at the door is decoration on a spread. The industry calls it net interest margin. And as of the first quarter of 2026, the average net interest margin across every FDIC-insured bank in America was 3.31%. Sit with that. 3.31%, that's your gross margin. Before you've paid a single teller, before rent, before the core processing contract, before compliance. Compare that to anything else. Software runs 80% gross. A restaurant runs 60% on food. A grocery store, famously the thinnest business in retail, clears 25% before overhead. A bank starts the race at 3%. So, how does anyone make money on 3%? 2 answers. And the first one is the reason banking exists at all. My first real job in this industry, I worked for a woman named Priya Raghavan, CFO of a $600 million bank in the Midwest. She had a habit of testing new analysts in week 1. She asked me, "What's a good return for a bank?" I said 12–15%. Reasonable. Equity investor answer. She said, "Wrong. A good return for a bank is 1.2%. I thought she wanted me to argue. She didn't. She meant return on assets. Across the whole industry, in the first quarter of 2026, banks earned a return on assets of 1.26%. On every dollar of stuff the bank owns, it made about a penny and a quarter over a full year. That sounds pathetic until you understand the second half. Because the bank doesn't own that dollar. It borrowed it from you. A well-capitalized bank runs on roughly 10 cents of actual shareholder money for every dollar on the balance sheet. The other 90 cents is deposits. Owners put in 10 cents. The bank earns 1.26 cents. Do that division. 10 to 12% on the money the owners actually put up. That's the trick. Thin margin, enormous leverage, and the two cancel into a return that looks perfectly normal on a brokerage statement while the business underneath runs on fractions. Priya used to say banking is the only industry where you can be right about everything and still lose the company on a rounding error. When you're levered 10 to 1, a 10% loss on your assets doesn't dent you. It erases you to 0. 10%. That's the whole cushion. Keep that in your head. It comes back later, and it comes back ugly. So you want to own a bank. Instinct says the hard part is lending, finding good borrowers, making smart loans. Almost everybody gets this backwards. Lending is easy. I want you to really hear that. Lending money is trivially easy. I can put $1 billion out the door by Friday if you don't care whether it comes back. Somebody always wants a loan. The scarce thing, what every bank in America is actually fighting over, is cheap, stable deposits. Let me make that concrete. A guy named Ray Oquendo. Ray ran a plumbing and HVAC outfit, 40 employees, banked with us since the 80s. His operating account averaged around $380,000. Payroll in and out twice a month, constant churn, and it never really dropped below 300 grand. Ray earned basically nothing on that account. He didn't care. He wasn't there for yield. He was there because his account officer picked up on the first ring. Same branch. We had a retired couple with $2 million in CDs. Ask 100 people which customer the bank loved more. 95 say the couple. They're wrong. That $2 million cost us real money CDs, repricing at market. And the second a bank across town offered 25 basis points more, it was gone. That money was renting. It shopped on a spreadsheet. Ray's boring checking account was nearly free funding that had sat still for 30 years and would sit for 30 more. We could put it into loans yielding 7%. On a spread basis, Ray was worth more than a customer with 5 times the balance. That's the real game. Not who has the most money. Who has money that's cheap and doesn't run. And when rates went up hard and the target range landed where it sits now 3.5 to 3.75, every treasurer in America discovered idle cash could earn something. Deposits that had been asleep for 15 years woke up and started shopping. The industry calls what happens next deposit beta. How much of a rate increase you're forced to pass along to keep money from leaving. Low beta, you print money. High beta, your margin evaporates. And you can't do a thing about it. You can't call 10,000 customers and ask them to be less rational. 3.3% doesn't cover a full-service bank on its own. So there's a second engine, and this is where banks make most of their enemies. Fee income, overdraft, monthly maintenance, wires, ATM, surcharges. Interchange the cut the bank takes every time somebody swipes a debit card. I worked with a compliance officer named Marisol Vega, and whenever somebody proposed a new fee, she had one line. Great idea. Which committee do you want me to explain it to, ours or theirs? Fee income is the highest margin revenue in the building and the most politically radioactive money in American finance. And there's a cliff in the middle of it that warps the strategy of every bank in the country. $10 billion in assets. Under $10 billion, you're exempt from the Durbin Amendment, and you collect full debit interchange. Cross it. And starting the following July, your debit interchange gets capped 21 cents plus 5 basis points of the transaction, plus a penny if you meet the fraud standards. I've watched banks in the 9 to billion range genuinely agonize over growth. Not because growth is bad, because crossing that line vaporizes revenue overnight, permanently. There are banks that would rather stay small forever than step over a line drawn in a 2010 statute. An overdraft? That revenue collapsed as banks got ahead of regulators. Then, in 2025, it ticked back up at several large banks. Some saying it's just more customers using the service. Some observers saying it's the enforcement environment loosening. Which tells you something. A real slice of your revenue doesn't depend on your customers or your management. It depends on who's running an agency in Washington. You can be a brilliant operator and lose 8 figures because an election went a certain way. So far, this sounds fine. Thin margin, big leverage, some fee income, decent returns. Now the thing that actually ends banks. Credit. Let me tell you about Tom Kessler. Tom was the best commercial lender in our bank. Not close. 30 years in that market, knew every developer, every contractor, every guy with a piece of land. Biggest loan book we had, and for 8 straight years his charge-offs were basically 0. Tom was a genius. Until he wasn't. Here's the cruelest feature of this business, and it explains almost every banking crisis in history. Loan revenue shows up immediately. Loan losses show up years later. Book a loan in March, you're booking interest income in April. If that loan is garbage, you might not find out until year 3, when the interest-only period ends or the tenant doesn't renew. So a lender making terrible decisions and a lender making brilliant decisions look identical for about 36 months. So the aggressive guy gets promoted. He's growing the book, his numbers are beautiful. He's outperforming the careful lender down the hall who keeps saying no. By the time the truth arrives, he's already run the whole portfolio. Tom wasn't reckless, exactly. He'd been right so long he stopped asking whether he was right, and he let the concentration in one property type get away from him. When that segment turned, it turned all at once. Remember the leverage math, 10 cents of capital per dollar. Tom didn't need to be catastrophically wrong. He needed to be somewhat wrong on a big enough pile. That's why every bank you've dealt with has that grim, overcautious personality. It's not that bankers are joyless. It's that the payoff is asymmetric in the ugliest possible way. Being right earns you 3%. Being wrong costs you the company. You've heard the risks. You still want it. Let's price it out. 2 paths. Build one or buy one. Building is called a de novo charter Latin from the beginning. A few years ago, I sat in on an organizing group led by Owen Delacroix, a former regional president who got squeezed out in a merger and wanted to do it his own way. Here's what it takes. First, seed money. Before you have a bank, a charter, or a single customer, you need cash for lawyers, consultants, market studies, application prep. Budget, $500,000 minimum legal alone can run $200,000, and it's not reimbursable. It comes out of the organizer's pockets, and if the application dies, it's gone. Second, an organizing group. 5 or more people with genuine local roots and real banking experience. You can't just be rich. They will look at every one of you. Third, the wall. Capital. The FDIC's general expectation has been 15 to 30 million, and in practice, recent applicants have raised 27 to 50 million, depending on the plan. Fourth, time. Approval runs well over a year, then 3 years as a de novo heightened capital requirements, more frequent exams, locked to the business plan you submitted. Want to pivot? Ask permission. Owen's group raised it. 18 months and a lot of dinners. Now the number that tells you everything about this industry. Between 2000 and 2008, roughly 150 new banks opened in America every year. In 2023, 6. In 2024, 6. It's picked up 31 charter applications were filed in 2025, though many were fintechs and crypto firms rather than community banks. And in the first quarter of 2026, 3 banks opened. 3 in a quarter, in a country of 340 million people. In that same quarter, 54 institutions merged into other banks. 6 were sold to non-insured buyers. 1 failed. Net change. The number of FDIC-insured institutions in America fell by 60 in 90 days, down to 4,278. That's not a business cycle. That's a one-way ratchet. Why does a country that adds hundreds of thousands of new businesses a year add 3 banks a quarter? Because of a cost that doesn't appear on any menu. The government's signature. Think about what the FDIC gives you. $250,000 per depositor, per bank, per ownership category. Guaranteed. That's why a 78-year-old widow hands her life savings to an institution she's never audited, run by people she's never met. You can't build that trust. You can't market your way to it. It's issued, and it can be revoked. And you pay for it in ways that never show up on a line item called regulation. You pay assessments into the Deposit Insurance Fund, $157.5 billion at the end of the first quarter. You pay in compliance staff. You pay in exams, where examiners live in your building for weeks and rate you 1 through 5 on capital, assets, management, earnings, liquidity, and market sensitivity, CAMELS. Pull a 4 or a 5 and you land on the problem bank list. 54 banks were on it in Q1, 1.3% of the industry, which is actually normal. But here's what outsiders never get. Marisol told me the real cost of regulation in a small bank isn't the salaries. It's that every requirement costs about the same in absolute dollars, whether you hold 300 million in assets or 300 billion. Same policy manual, same testing, same reports. So compliance is a fixed cost in a 3% margin industry, which makes it a scaling subsidy. Every rule written to protect people from big banks makes small banks slightly less viable and pushes the whole industry toward consolidation. That's not a conspiracy. Nobody designed it. It's arithmetic. And it's why we have 3,852 community banks today and fewer every quarter. Now the part that surprises people. Most banks that fail are not insolvent when they fail. Everybody assumes a bank collapses because the loans went bad. Sometimes. But the classic modern failure isn't a credit event. It's a speed event. Here's the mismatch at the heart of every bank on earth. Your liabilities deposits are due instantly, on demand. Your assets, loans, mortgages, securities are locked up for years. A 30-year mortgage is 30 years. You're borrowing overnight and lending for decades. And the whole structure rests on the assumption that not everybody asks at once. That held for centuries, because withdrawing money meant physically going somewhere. There was friction. A run took days. Now everyone has the bank in their pocket. A rumor moves through a group chat, and billions can leave before the executive team finishes its first meeting about it. And the security side makes it worse. When rates rise, bonds you bought at lower rates fall in value. On paper, that's fine. Hold to maturity, you get paid. But if depositors run, you're forced to sell those bonds today, at today's price, and the paper loss becomes real. Now you actually are insolvent. The run doesn't discover the insolvency, the run creates it. That's a wild thing to own. A business where perfectly healthy becomes dead in 72 hours because enough people believed it might? Your product is confidence. Your inventory is other people's money, and your solvency is partly a function of what strangers think about you on a Thursday. So, say you make it. You survive the de novo period, you build to 400 million in assets, credit's clean, deposits are sticky. What's it worth? I got educated on this by an M&A banker named Gwen Marchetti, who did nothing but community bank deals and had the weariness of someone who'd watched a lot of founders learn it the hard way. Bank deals price off tangible book value, not revenue multiples, not EBITDA. Tangible book what's left if you liquidated everything and paid everybody off. A decent community bank might trade around 1.25 to 1.75 times tangible book, depending on your market, your deposit mix, and your earnings. Notice what's driving that. Not your loan book the buyer can make loans. They're buying your funding, your deposit base. Ray Oquendo's boring checking account times 4,000. Gwen told me the founders with the best outcomes were never the ones who grew fastest. They were the ones who spent 15 years accumulating deposits nobody else could pry loose, in a market a bigger bank wanted and couldn't easily enter. Boring, patient, local, 15 years. That's the trade. So, should you own a bank? Be honest about the picture. 20 to 50 million up front and 18 months of your life just to open the doors. Gross margin of 3.3%. Leverage of 10 to 1, so a 10% loss ends you. Your best lender looks brilliant for 3 years before you find out whether he is. Your fixed compliance costs punish you for being small. And you can be solvent Tuesday and gone Friday because of a screenshot. And yet, this industry made $80.5 billion in a single quarter this year. Not a year, a quarter. Bank ownership has minted more quiet, multi-generational, small-town American wealth than almost any business I can name. Not flashy wealth. The family that's owned the bank in a county seat for 4 generations, with their name on the hospital wing. Because when you own a bank, you're not really selling loans. You're selling the exact same thing the temple vaults in Babylon sold 4,000 years ago. Your money is safe here, and it will be here when you come back. You collect a small toll on every dollar that passes through. It's a tiny toll. But every dollar in the American economy passes through somebody's bank, and if you own the road, small tolls add up to an empire. That's the whole business. Thin margins, enormous leverage, and a promise you have to keep every single day forever. If this changed how you look at that number in your banking app, hit subscribe. I break down the real economics of a different business every week. And drop a comment telling me which one you want next, because I genuinely pick from that list. See you in the next one.